Entrepreneurs always ask, what's the value of my company? And I usually respond to that question by saying, maybe the correct question to ask is, what's the value of your company to our investors? And that answer is not as straightforward as it seems, because a lot of the entrepreneurs that we deal with here at the Capital MatchPoint are in emerging growth industries. And one of the most common methods of determining the value of a company is the price-to-earnings ratio. Well, in emerging growth industries, the market is usually not defined enough such that there is an earnings history that you can go back and make a real price-to-earnings estimate for companies in that market space. So as a surrogate, investors sometimes use a ratio called the price-to-sales ratio. Price-to-sales is very similar in its calculation to price-to-earnings ratio. Let's take Company A, for example. Let's say that our Company A's stock price is $20, and let's say that the most recent 12-month period, Company A had sales of $20 million. Assuming Company A has 1 million shares of stock outstanding, Company A has a price-to-sales ratio of 1. Now, an investor is going to take this information, look back, and instead of going out and digging up price-to-earnings information on companies in your market space, they're going to look at price-to-sales. And they're going to use this as an indicator of value of your company, which is ultimately the indicator of what they're going to be willing to accept in terms of equity in your company in exchange for a cash infusion. It's important to understand, or it's important for an entrepreneur to understand what their price-to-sales ratio is. Again, especially if they're in an emerging growth industry, because they want to be as well prepared as possible when the time for negotiation comes.